All right, welcome everyone. My name is Kevin Hurley. I am the owner and managing partner of Hurley Investments. Welcome to the high market view commentary for January the 13th, 2020. Most likely next week being a holiday, I will not have a commentary, but I will pre-record one. And I will pre-record it and I will have it on myhurleyinvestment.com. Again, that'll be myhurleyinvestment.com. With that said, give me a quick second. I'm going to, well, I guess I'm not going to do anything, but yep, give me a quick second and I'll be right back. All right, I'm back. Sorry about that. I love going over this first week because this first week I have had a tradition going on since probably 2009, and it's talking about SMART goals. Everyone gets into goals at the beginning of the year, and in all honesty, man, I wish people would use a little more common sense. So the first thing I usually like to talk about are SMART goals. More often than not, when I first talk to people about, hey, talking about Hurley Investments, it's not what I do. It's not what I do different. The first question is what? What is always the first question that people ask me when I guess I get to introduce Hurley Investments to them? Bingo. Mary, awesome. Always, first question. So what are your returns? What are your returns? Second one, I don't care. Making as much money as possible within existing limitations is very good. With that said, a good health is the main goal. Again, within laziness boundaries, ADP, I love it. Most people will come and tell me though right away, how much money did you make last year? It's what your yearly return is. And I find it interesting because that's where most people go. Yet rarely do I get judged on a yearly return. I get judged on a daily return. And I'm like, come on, guys, give me a break. Some people think they're okay with all the risk and want all the return, I guess. And some people want no risk, but still want all the return. So when I go into talking about goals here, most likely I hear two things. How much should you make by the year? And then most people have an unrealistic expectation on what they're going to make year in and year out. The reality is we can't predict what the market's going to do. And no one really predicted last year's good growth, to be honest with you. With that said, thank goodness we have some buy for this year. And Boeing's, I'm going to talk about Boeing as some of the stocks I'm looking at. But in all reality, if you're setting a goal, you need to take your risk to reward into place. Yes, it is possible to get a 100% return on a portfolio. But if you're doing that, it's also very possible to get a negative 100% return on your portfolio. In fact, if you are going for 100% return, chances are you're looking at 3 to 1 that you'll lose everything versus make it all. And that's just common sense. That's just the amount of risk that it takes. I appreciate color trading. At the end of the goal setting, I tell you how I would run a typical portfolio. With that said, the S, when you're looking at goal setting, stands for simple, specific, and schedule. I do think more people will lose money in 2020 because of the volatility we should have going through an election year. So that comment was just made. Yes, I think because of the volatility and because of the ego, people that just think you just throw money in and you make money, that more people will lose money in 2020 than they make it. Sorry, I forgot that question there, Mary. All right. Simple, specific, and schedule them. I like the old acronym, the KISS principle, right? Keep it simple, stupid. When you're looking at goals, when I'm talking about simple, specific, and schedule, I'm looking for goals you're going to do over a daily, weekly, monthly, or quarterly. Most of those goals should be simple, specific, and scheduled. Now, I'm going to talk about another set of goals on your yearly goals. But again, my belief is that keep it simple, stupid. Give yourself attainable goals. Make sure you're looking at your goals on a daily basis. In all reality, I usually at the beginning of the year set some big term goals, some big goals that I want to hit. And then I work my way backwards. And it's just a way for me to see if it's attainable and doable. When I talk about the M in SMART goals, measurable. Most people set a pinpoint goal. And if you ask most people, and I bet most of you will fall in this category, if I asked you what your goal is for this year, how does my sound, by the way, right now? Do I still sound okay? I just got that my sound might be a little wavered there. All right, still sounds good. Thank you, guys. M is for measurable. And most people, again, if I asked you, you'd say, hey, I want a 25% return this year, right? You set a pinpoint goal. I might suggest setting a range goal. And most people, when they talk to me, the first goal I always try to hit every year is I want to beat the historical 7.74. And that even has gone down. In all honesty, a more realistic goal for the S&P 500, if you're not counting, oh, you got to count, dividends in there and so forth. And a goal, instead of going all the way back to World War II, but more after the Vietnam War in the 70s, it's really about a 7%. So I always try to set my first goal at 7%. That's what I want to hit. From there, it's always 15. From there, it's over 20. That's how I look at my goal setting, especially for the market. Now, have there been some years and some people that have made much more than that? Of course. In fact, once you get color trading under your belt for a year, and maybe you get called out on some things, so you can shift from stock ownership to leap calls. Once you've got something like Baidu, who's taken such a huge dive down, and you can get your cost basis for most people in that $113 to $118 range. As things bounce back, all of a sudden you start to get bigger returns. So the M, make it measurable, but I'm going to suggest instead of just saying I want a 25% return, I want 50% return, make it a range goal. Give it within that goal different numbers to hit as you're going up. Attainable. 9 out of every 10 traders I talk to will tell me when they make their goals in some way, shape, or form, I want to be a better trader. I want to trade full time. I want to be a stay-at-home dad or stay-at-home mom. I want to be a millionaire. That always comes down along the lines of goals, right? I want to make it to $1 million, which is kind of funny because $1 million won't even get you through retirement anymore, I don't think. But if you see I underlined it, too many people at the start of every year write down a wish list, not a goal. It's not something that is realistically attainable. If you need to live off of your money and you've got $200,000, you need $60,000 a year to live off it, very rarely are you going to hit a 35% return every single year. Just doesn't happen. But Kevin, they're doing it in the education that I'm with. Well, are they or are they not? Are they doing every single trade? Is their education part of paper trading? Do they have the disclaimers in place to protect them from telling you in real life, hey, we're not doing the trades fighting fear, greed, and volatility because it's in a paper trading account. The education I've been associated with, I've been very proud to be associated with because he's by far the most honest that I've ever seen when it comes to trading. It's, I don't do every single trade. So really what I'm getting at with this one, is it realistic? Can you backtrack your way through and realistically get to where you want to be? Is it attainable that you can look at your past performance and say, hey, I did 50 last year, I can do 50 this year? Does the market give you the setups? Have you selected the strategies that'll properly fit your risk tolerance and market expectation? So the A is for attainable, because in all reality, let's face it, I'd like to weigh 205 pounds again. It's not going to happen anytime soon, right? I'll be lucky to get down to 230, 225. So that's just a thought process there for you. R, realistic and relevant. It really, again, I've probably kicked this horse long enough. If you have $200,000 and you live off of 60 or 80,000, it's not going to happen. You're going to burn through your money. Look at how be realistic. That's all I'm trying to say here. And T is for time. Set the proper time period you want to accomplish your goals. If they're life goals, give yourself more time to do it. If it's a weight goal, give yourself time to understand where you're going to gain and get it back up again. In all honesty, you need to find support through the tough times. And my T for time really comes down to that last two sentences. Whether it's between you and your spouse, your kids, your parents, your education program, or maybe the good Lord himself, find support during the tough times. I promise you that they will come. You're definitely going to have some tough times when it comes to trading. It's not an easy thing to do. If it was, everyone would be licensed, bonded, insured. Everyone would be doing it. But I'm not trying to poop on the goals. I still set up goals. I still stick one in my planner, one in my bathroom sink, one on the back of the door. So in all honesty, I will see my goals a minimum 12 times throughout the day to keep myself accountable. And this goes all the way back down to high school football when I was told I was never going to get to play. And I set the goal and I just pushed myself through it to give myself that opportunity. That's where this came through. I'm taking a 14-year-old boy who had to set realistic goals to get him to where he wanted to be. And I've stuck through it ever since. I'm going to give you 30 seconds to look at how I would be setting up a portfolio. Take a quick peek here and look at it. All right. 70% of your portfolio. cash or T-bills. In all honesty, there's a place for everything. I would not run any T-bills in my current portfolio, to be 100% honest with you. That's not the way I would see a portfolio. But I might keep 10 to 15 to 20% of cash in place. With that said, I'm going to go over what I'm looking at this year, and I would want to be a little cash heavy going into May. I would definitely want to be cash heavy and be willing to get out of some positions during summer if we can get a profit on them. And I think we'll have a pretty good buying opportunity sometime before the election. Or I also would think we have a pretty good opportunity to pick up some good shares with a possible correction that our market should go through. We did have a stealth one 2018, really, that when our markets fell from, oh, where'd it fall from? Fell from July, June till November. Huge down year in 2018. We had our stealth, I tend to call it our stealth correction. Over 10% from top, or 20% from top to bottom almost. Definitely a correction that was had that was kind of stealth because it was jagged. I want some cash available to take advantage of an opportunity. I don't know when that opportunity comes, but I want the cash available so that when it does come, I have the opportunity to capitalize on it. So really, maybe 10% would be in cash. They say T-bills are cash equivalents. It's up to you. But really, the majority of my long-term trading is in collar trades, protective puts, covered calls that might be deep in the money. I'm taking a lot of protection for the majority of my portfolio where it's not at risk. Now, I've got some medium risk trades. Bull puts, put calendars, call calendars, strangles and straddles, put and call ratios, wing spread, bull calls, bear calls, strangle straddle, bear calls in general. It's just more of the option spreads in general. ADP, I'll get to that question quick in just a minute. So this is where I'm trying to capitalize on small, shorter term trades where 20% of my portfolio, I might have a neat return. And then I'm going to call them high risk trades. Straight long calls or long puts, naked short puts, naked short calls, outside of the box trades, which are Vegas trades. Now, I would say in general, this is a pretty standard portfolio that I try to run. I try to run it within these ranges, give or take 5% one way or the other. With that said, if we're taking a look this year, not bad. Not bad to have over a 3.5% return. Not bad down 12 million to have, 24,000 away from being a 4% return. But when it comes down to it, Apple, a big majority of the portfolio, right? Apple is 2.240541, $2.2 million. Which I'm running in, plain and simply, deep in the money cover calls that I had last year will free up some great cash. A bunch of leap calls, a protective put. Now, kind of fun to be able to brag a little bit here, right? When my covered calls were going to take my stock away from me, I then reverted to some leap calls. Pretty neat to pay $27.65 and have $93.82. It's mark right now. It's cost. Pretty close in this account to being at a 300% return. For my other 8 that are being taken away right here, kind of neat to have replaced them. 27.84, already at a 400% return. Couple newer ones are in here. 41 cost basis, already up 25%. And here's the question for you. If you're going to treat the leap calls as a stock replacement strategy, why in the hell would you get out at a 20% return? It's a stock replacement strategy. Yes, it is high risk, but in all honesty, if I'm going to get called out anyway, right? Cost basis is quite a bit lower than that. It's more in the 180 range because of long puts, in which case it got me to this position. Same thing here. When I look at the covered calls here, some are at 177, some are at 146. Huge amounts of profit there to take $27.80 and turn it into a leap long call position. If you want to see over a year's period of time a 300-400% return on a leap call position, if it's a stock ownership replacement strategy, for crying out loud, treat it as a stock replacement ownership strategy, which means your risk, let me take that back, your hedge is the position here itself. Right now we have stock ownership at a ridiculous high number, right? We have stock ownership at 316. Well, Kevin, when you put these on, it was 10% of the portfolio. Yes, it was, which means a leap long call takes 90% of the stock ownership risk out of your portfolio. But Kevin, you can lose the whole $27.65 or $27.80. Yes, you can, but you wouldn't lose $316 or $220 at the time. Yes, you could lose all that you paid for your leap long call. But it's a stock replacement strategy. So you could add some long puts on it. You could treat it like stock and dollar cost average. You should definitely hold it on for the period of time that you think you are going to see major stock movement. And with all due respect, you're an idiot if you pull it off with a 20% return. There's too much risk in spending $27 when you can do bull calls and bull puts and call calendars. Swing for the fences. Treat it like stock replacement. Give yourself the opportunity to have a 100% plus return in a leap call position that does hold a little more risk than maybe it should in your portfolio. All right. I'm showing some of this because covered call, deep in the money covered call on American Airlines. AOBC is a protective put. We've got quite a few. We only have 1,000 there. Not too many anymore. Boeing. Boeing's going to be one of my swing for the fences. We're adding leap calls on Boeing. Protective put, but leap calls are there. Bank of America, we're taking off. When we have taken off all of the leap calls, we're in a protective put, and we'll let Boeing get called away if we need to. Costco, I got a couple leap long calls on Costco. Looking for some opportunity there. CVS would be a rather new position getting into it. Disney is still same old Disney. For crying out loud, I really like to see this one get up to the 196 range that it should be. But we do have a couple of leap long calls sprinkled in with 13,000 shares. Ford, quite a bit of Ford, tens of thousands of shares of Ford with a protective put. Facebook is more on the leap long call side again. Kind of like it, you know. Pretty cool. Again, when you can get over here and say, hey, doing pretty good. Average cost of $15.31, 100% return. $12.25, 100% return. Couple ones we're starting in. I really need to go back to Baidu. Still quite a few stock shares. Still letting them run, getting ready to put on some protection. But again, if you're looking for some amazing returns, dollar cost averaging, $4 basically, $3.96. Now we're 17, over a 400% return. $12, now averaging 33, 100% return. We've got some newer ones that we're working in here. I guess I'm just trying to say, look at your positions that you have and use them wisely, use them accordingly. Facebook, Disney, Ford, what else can I show you? Last year, we took some good profits on Visa. We will probably do the same thing around June-ish. Take some good profits, roll it out and up. Normally, you don't want to hold a leap long call position into expiration. Can someone tell me why? Why do we not want to hold a leap long call into expiration? Perfect, good answer. Because you paid so much money for it. So what you're trying to say is probably time decay. You don't want all that time decay to be eaten up. I agree with you. But I might very well keep two of the positions, the Facebook and the Baidu. In all honesty, Baidu by June could be worth $200. In which case, on all those cheap $3, the $3 long calls could be worth like 65 bucks. How cool would it be to have like a 2,000% return on something, right? Let's do the math on that. How cool would that be? How cool would it be to do a $4 divided by $65, only 6%. So how would I do that? Divided by 4 would be like 1,625% return. That would be killer, right? That would be pretty darn cool. So I'm going to kind of leave it where it is right now. If you were to ask me this year what I'm looking at doing, New equity positions for 2020. I really got to remember that. I'd be looking at Key Corp, FCX, Micron, Murphy Oil, Starbucks, WBA, which is Walgreens Boots Alliance, but I like CVS better. But these are some of the ones I'm really looking at. I still like my favorites. I have them in here. I'd probably take Under Armour, and I'm going to put it this way. Boeing and Under Armour are my wild cards this year. In all honesty, I think Boeing will be at least to 450 by the end of the year, if not 500. Oh, Kevin, they've got so much to do. I know. As I had a talk with Jeff Schaffner, if he's here today, yep, there's Jeff Schaffner. We're going to be over leveraged in Boeing for some people, and my comment is that's okay. Kudos to Jeff to have to deal with me. I think I've also made that comment to Bill Brandner, both Dave and David and Lance. As I talked with you guys, it's okay to be over leveraged in Boeing this year. The reason why? Because I said so. Interesting to see that. A question came in, and both of you actually said it a couple different ways. One says, which stocks will be more positively affected with the signature of the U.S.-China agreement signature? And then another comment was made, how will the China phase one deal affect U.S. stocks? So in all honesty, I'm going to tell you, other than Baidu, I'm not sure the China deal affects the U.S. stock market at all. If anything, I think it's going to help the Chinese stock market, and it will ease global tensions, which means, in all honesty, it'll probably raise the European markets. It'll raise some of the emerging markets. It'll definitely raise the Asian markets. And a phase one deal and some future date for a phase two deal will not directly affect any one given sector or group of stocks. Well, Kevin, it's 20 to 30 to maybe 50 billion of agriculture, which is true. So maybe it's going to affect Kroger's, maybe it'll affect some that are related to the agricultural market. I do not think it's going to affect Deere or Caterpillar. The reason why is I think it's just getting China back to where it used to be, not a big growth catalyst necessarily for the agricultural side of things. So I don't have a stock or a sector other than Baidu. Baidu is going to be related to the Chinese economy taking off. If the Chinese economy takes off again, probably Baidu, Alibaba, Tencent, you might see a bunch of those take off, which if you're really looking to capitalize on a Chinese-US agreement, you're going to go to those Chinese stocks that have been affected by the tensions between the US and China that'll trade on a US exchange. My winner is Baidu. Baidu came down from 228, 288. We had a huge drop in Baidu. 288, huge run down. I think it has a huge run up this year. I think it goes back and retakes those highs at 288. I think it can be 200 by June, in which case I'm going to make a killing. In which case my clientele that's in Baidu will make a killing. My wild cards are Boeing again. Two reasons for Boeing. 10-year backlog. Its main profit is not the 737s, it's the Dreamliner. Until Airbus creates 5 times the amount of planes that Boeing does, I think Boeing has the edge on profitability here. and go Boeing. Under Armour. Under Armour is doing all the right things when they were doing all the wrong things before. So Under Armour, I think they catch a break with global tensions. They'll catch a break with China where they use or have some of their sweatshops. Oh, did I just say that? Where they get some of their materials from. I'm sure their sweatshops can't be any bigger than Nike's, right? So really, I think Under Armour, it's time. I almost wanted to slip Ford in my wild card, but Ford really should trade that $17 to $22.50 range. It just should. With that said, I don't know if they're doing enough right things this year to get there. So I don't know if I would feel comfortable. I don't feel comfortable being able to tell you it's okay to be over leveraged in Ford because it's not right now. Smaller accounts, the SPY, the Qs, the diamonds. I do like the IBB for a smaller account, XLF for financials, XLE for energy. That would be my smaller account suggestions. That maybe it's just easier to play some of the indexes on a covered call strategy. Some of these I would do leap covered calls on. A leap covered call on the XLF and XLE is a great way to give yourself 7% downside protection and a 7% return for the year. So if I was going to say, let's talk about this year, couple questions. What kind of year are we going to have in 2020? What kind of year are we going to have about in 2020? An election year, right? So we know we're going to have a pretty volatile August, September, October, November, maybe a September, October, November. What else? Tax selling. Lance, why would you say tax selling? Lance, why would you say tax selling? And I'm going to assume April is what you meant there. You don't know. Okay, well, last year we didn't have very much tax selling. Not a whole lot of end of the year selling, so it seemed like people were pushing the sales into this year. That would go by volume to verify that. I also think, I believe, not thinking, I guess I believe that I did hear Trump say he was going to go through hey, look who there. I did see I'm not just saying it right. I did see a possible Trump 2020 tax reform or tax 2.0, in which case I definitely could see some tax selling in April. No one has mentioned this yet, but I would also tell you, look for a correction or a short-term bear market. And those are just pretty standard drops. And again, if I was to go to show you anything, I would tell you, taking a peek, SPX, and I'm going to bring this out to, I'll say 5 years. Won't get all that out there, but look at the end of 2018, 2346 to a high of 29.40. And if I do some math there, 29.40 minus 23.46 is 594 points divided by 29.40. We're looking at 20.2% bear market sell-off is the best way to say it. And to really look at that in a little bit simpler, let me just put this back 2 years, right? Right here, and I kind of call it stealth, right? What a stealthy drop down, up, triple top, bottom fell out. That was a pretty stealthy correction we had in our market. In fact, it was even touched the bear market by 0.2%. I think we're going to see that same potential this year. Yet I don't think it's going to be so stealthy. I think it's not going to be a sideways last quarter. There's enough profits that people will freak out and take their profits, and off we go. Being in an election year, as we said, we're looking at more volatility than last year. Short positions should garner more credit. Bigger drops on a 10-year run on the stock market equals more profits to be taken. If I was to ask this group, who's going to win the election this year? Trump or a Democrat? Who's going to win the election this year? Trump or Democrat? Trump, no doubt. I like it. I would probably fall in that same camp of Trump, no doubt, as well. I don't think the Democrats have done anything to help out their cause. I don't think the Democrats even have a platform that's realistic for what's needed in America. And for that reason, I would think that we would have, I would think that we're going to see Trump win, no questions asked. In fact, Rich said Trump, both Dave and David said Trump, Mary said Trump, ADP said Trump, I'm saying Trump. So that would be my expectation as well. It's Trump's to lose, right? With that said, I think the key is the House. Can the Republicans for 2 years run everything along? And can the Republicans jump on board to keep pushing America first, to keep pushing our industry forward? And we had it for 2 years, and, I'm going to blame McCain. McCain blew it for us. I think some of the Republicans in name only couldn't stand up and couldn't stand for having the country run like a business. It's too easy to run it like a pork barrel instead of a business. Dow Jones Industrial Average, bullish. Bullish with earnings starting this week on Wednesday with Alcoa. We're going to keep running to the high side, I believe. In fact, I should probably say that. If I was going to make a comment here, I think it's guidance. Earnings, global growth, and how did I say it? And cash on the sidelines. Pouring back into the market. So really 2021 after the election, we can have this serious correction pullback that our market needs. S&P mirrors the Dow. Kind of nice to see. Pretty amazing. The other day we hit 29,000 on the Dow. See if we can't get back up there, right? Although it's a pivot point, right? 2951.69. Pivot point, a little first resistance level, short-term resistance, right at 29K. NASDAQ bullish. Been bullish all freaking month, right? Go NASDAQ. If you had asked me at the beginning of the month where I thought January would be, 2%. I think we might make some bigger moves with individual companies, but it'll be guidance that matters going into the first quarter. Earnings this week, Citi, Delta Airlines, Wells Fargo. Not a fan of Wells Fargo, by the way. United Airlines, JP Morgan. I will be paying attention to JP Morgan on Tuesday. Goldman Sachs, USB, United Health, Flora House, Alcoa, Bank of America, BlackRock, Morgan Stanley, Schwab on Thursday, First Horizon National, Schlumberger on Friday. Just starting into our first week of financial earnings, and with Alcoa, you know, between Alcoa's Wednesday's report and 6 weeks into the future, we'll have roughly 80% of the S&P report. Economic reports, this is our inflation. Should be pretty tame, but it'll be a big day on Thursday. Retail sales, business inventories, NAHB housing price index, and building permits on Friday. Building permits and housing starts on Friday will not be that important. It's seasonal, that won't matter. Capacity utilization, industrial production will probably run our futures come Friday. Internationally, there were some China and some Japanese stuff. Nothing that I felt was going to move our market, so I didn't put it in there. When it comes for how I'm looking to trade, I have earnings coming up, protective puts. I'll probably do no short calls except for maybe Apple, which is so overvalued right now. I would be looking to put some short calls on Apple. But here's my earnings list. I will have it posted for you. Paying attention to what's coming up for earnings, and we'll do protective puts through earnings, still letting them run higher. I have got a weekly pulse from briefing.com for you to read through. Really, I'm getting to Art Cashin. His predictions for this coming year. Prediction 1, despite a U.S. strong economy, there'll be no Fed hikes in the next year. I would agree with that. Usually you're not going to, I mean, that's a pretty easy prediction, right? Really, there's going to be no Fed hikes because it's an election year. And for the most part, the Fed doesn't like to take part in pushing an election one way or the other. Prediction 2, the market winning streak will continue. The broader indexes will be up in 2020. I would agree with that as well. It might not be, we might have zero growth until after the election and things take off from there. So this really could be a November gain a lot of your returns unless you went and you did some stock picking. Stock picking like Disney that has a new revenue stream that should match their movies. Stock picking like Baidu that's on a tear up as China starts to increase. Stock picking like Under Armour who gets some of their product from China. Prediction 3, stocks may be up, but there'll be several points of volatility, particularly in January, March, and July. I would probably turn that to March, July, and October. March for the pre-sell-off for taxes, October more for the election. And Art Cashin is one that I typically listen to. He's a smart man. Don't look now, but Goldman Sachs is saying the economy is nearly recession-proof. A very interesting read. And all this comes down to is a buy the dips. Still buying the dips, at least by Goldman Sachs and by Citibank, is in play. In fact, I'm going to try to see if I can find the Citigroup recession indicators. They're like 18 indicators. In 2008, 14 of the 18 were flashing the previous year. In 2000, it was like 17 of the 18 were flashing the previous year. So when you get 7, 8, 10 of those indicators flashing for Citigroup, normally you then will have a pretty real threat that you're going to go through a recession. Dividend yields, dividend stocks look attractive. The volatile year that nets measly returns expected ahead. Just put it in here because I somewhat agree and I think you should be made aware of it. More importantly, well, I guess not more importantly, I've got a Micron article in here that was given to me by a client that I thought I wanted to push your way. More importantly, the 13 things you should give up if you want to be successful. As I took a look at this, I thought pretty interesting on some thoughts here that I thought you guys might enjoy, and I would agree with you. I'd agree with you if you wanted to start to do some of these. Number 1, give up the unhealthy lifestyle. Just taking better care of your body. I usually do eat pretty healthy, but my physical activity sucks. Busy, sitting behind a computer, right? Give up short-term mindset. I completely agree with this one. It's the reason why I don't day trade. If you're going to set life goals, give yourself your life to do it. The short-term mindset is just a waste of time. I like the idea of giving up playing small. I think if you want to start your own business, if you want to make a footprint in the world, be helpful in your community, I think you need to start dreaming big. I think you need to start playing in the big leagues versus the small leagues. Give up your excuses, right? If I was to ask you or tell you, excuses are like what? Nope, don't type it in there. But yes, give up the excuses. Don't find reasons why you can't do something. Find reasons why you can. Give up the fixed mindset. It was pretty interesting. I still remember the conversation when I told my wife what I was going to do. And I know she just thought, man, I thought my husband was smarter than he was. And it scared her. For her, the stock market was gambling. There wasn't a systematic approach to make some consistent returns for her. And that's the fixed mindset. I should give my wife all the credit for sticking with me on this journey of management in the stock market, doing it for all this time. But it took some sacrifice on her side. And it's that fixed mindset, getting out of the way of looking at how to create something different to be helpful. Giving up believing the magic bullet. There is no magic bullet. Pretty interesting. I didn't agree with 7, but they're correct. Give up your perfectionism. Nobody's perfect. And when it really comes down to, I'm going to tell you, don't give up your perfectionism, but stop beating yourself up when you don't make it. Pick yourself up. Stop needing to find the perfect trade. It doesn't have to be perfect to make money. Stop trying to find the perfect stock. There is no perfect stock. You can make money on stocks that you don't like. You can make money on imperfect stocks. You just got to find your perfect wife, right? Or your perfect spouse. That's maybe because mine just walked in here. And maybe she just heard what I said before. So, hello. Give up multitasking. Again, I wasn't sure I agreed with this one. And as I read through it, I agree. You'll never reach your destination if you stop and throw stones at every dog that barks. There's something to be said about focused intensity. And I think if you're going to give up multitasking, I think what they're trying to say is find your main goals and focus on your main goals. Stop wasting time multitasking on things that aren't going to get you where you need to be. Number 9, a big one for me, give up your need to control everything. You can't control everything, so focus on what you can control. Number 10, give up saying yes to things that don't support your goals. This is a big one, and this really gets to 11, which is probably the biggest one for me. Not only give up on saying yes to things that don't support your goals, give up the toxic people. I don't know if I believe with John Rahm, but you are the average of the 5 people you spend the most time with. I don't agree with that. I don't agree with that at all. There's some sound in the background. We'll work on that. I don't know what that was. Do I sound okay now, though? That might have been my wife winking at me. Sometimes love can be heard through the air. Do I sound okay, though? Sounds good. Thank you. Give up on the toxic people. For me, it's always been rather difficult for me to give up on someone that needs the help, on someone that needs to get better returns, or someone needs to be protected. I know we're in for another horrific crash in the very near future, most likely being next year, the year after. I am kind of curious to see what Trump's going to say when the stock market tanks like a rock and he's got no control over it, right? But I do think you need to get rid of those people that aren't helping you achieve your goals. Those people that aren't going to get you to where you need to be. It's not necessarily nice. It's probably not fair or Christian. But if you spend time with people who are more accomplished than you, no matter how challenging that might be, you'll become more successful. And I think you're looking for those type of people to build yourself with than not. Give up the need to be liked. I appreciate that some of you do like me and I can call you my friend, but I've never gone into this trying to make my friendship the reason why people are joining my company. It's always been a working relationship that I don't care if you like me. My niche market is to protect portfolios so no one goes through a 2008 again without making money during those years. And number 13, give up your dependency on social media and television. It's been amazing how, since I run a business, how less important my football games have been on a Sunday. Social media is tough. I'll be honest with you. I probably check Facebook a couple times a day. It's interesting how social media can gobble up your time. And that's what I have for you today. I guess we're only going to do a full hour, but questions. What questions do you guys have that I can help answer for you looking into next year? And if you have none, type in none. Tomorrow will be a pretty busy day for me. Have the state, have the SEC. It'll be, it just seems like I got a day lined up with orders. Osmosis of behavior is a fact of life for humans and dogs. For those that are here, I will start up the trade findings and adjustments tomorrow. We will not have a Thursday one. Next week being a holiday, I plan on not running a commentary. I will just get one posted on the the myhurleyinvestment.com for everyone. All right, I see no questions coming through. We've had 18 of us here tonight. I appreciate you being here. For those that are clientele, I will have the trade findings and adjustments up and going for you tomorrow. Look for an email overnight. I will start a pay-per version for the trade findings and adjustments. That'll be at hurleyacademy.com, and that is still probably a couple weeks out. Guys, have a wonderful evening. I look forward to being with you. I'm glad to start to dip into the educational side to give some people some help in the stock market educationally with trades and a trade advisory, and being licensed, bond insured to do so and to give that advice without giving it to them in theory or, without not being licensed. If you're not licensed and you're giving trading advice, you're running the risk of getting sued for everything you own. Guys, have a great evening. Pleasure spending the time with you. I will get this one posted here tonight so you can look at the notes. I appreciate you being here, and I look forward to seeing you in 2 weeks. Good night, everyone.